So, huge week. Obviously, mega cap's going to be front and center. But this move in yields is going to have maybe the most outsized impact on where stocks go because of what we're just witnessing today. Yields are up, stocks down, yields come off, stocks go up. Is it that simple?
Well, I don't think it's simple at all. I think we're going through this whipsaw environment where people are trying to decide whether we're okay with the 10-year going down or we're okay with the 10-year going up. Is it sending a bullish signal or a bearish signal? And I think one of the biggest things, I know I've been talking about this ad nauseum, but is the yield curve inversion and the fact that it got down to the narrowest level since a very long time. We got down to 12 basis points today. We're back to 22 basis points inverted now. But that's a really small level. And thinking about the idea that it's not the yield curve that causes a recession, right? The yield curve doesn't actually do anything. It's more the signal of what capital looks like in the economy right now and what people's expectations are for the economy. And at some point, I do think the 2-year will start to come down, which will then send a more decidedly negative signal for what might be to come.
The real question, Joe, is whether, look, we've had this big move in rates and whether yields are topping out. Now, I don't know how closely you watched every tick by tick of the market until showtime today, but it appears to us that, and others, by the way, who I've spoken to, that Bill Ackman moved the market today. So we worked up this chart, which shows you the time that he tweeted that he covered his long bond short, which he's had on for a long period of time. So we're showing you that now. Over on that other side of your screen, right? So, Dow's down by more than 200 points. Ackman tweets that, and at basically the same exact time, you had yields start to come down, and then stocks do the exact opposite, which went up. Now, the Dow right now is up 24 or so points. It appears that's what happened. He says, quote, "There's too much risk in the world to remain short bonds at current long-term rates." The implication being all that risk means people are going to end up buying treasuries, and that's going to force rates lower. What do you think?
I think it's a great trade by Bill. I think it's an excellent trade.
Time to cover, you mean?
I think
that short?
No, I think the fact that Bill consistently throughout the third quarter was messaging to markets that he was short treasuries. He sat with you at delivering alpha and basically doubled down on that position, reiterating his short position. And like any good trader, Bill has the ability to observe the environment and then change his mind accordingly based on what he sees. And I applaud him for that. I think it's a great trade. I agree with his assessment of where the economy is. I think the economy is, without question, decelerating.
He says it's weaker, than people think.
Absolutely.
And that the data would otherwise show. We could show you. I mean, there's the intraday. Guys, throw that back up, please. That was the intraday of the 10-year. I mean, we could show you just an intraday of the S&P. Yeah. As well. You'll get the same idea if you overlaid those, by the way. I mean, you'd see from the moment that tweet came out with his trade that he covered the long bond short, the market just flipped.
It did. And today is the type of day where there's no real earnings, there's no real economic news. So to have that type of news where someone who has been speaking so much about the Treasury market and his position in the Treasury market, now he covers it accordingly, you're going to get not only a technical lift in the market, but you're also going to get that lift based on perception overall. I don't think it washes away a lot of the challenges that we have as it relates to earnings, and we'll talk a little bit about that as the show moves on, but certainly you're not getting rewarded for good earnings, and you're getting punished for really bad earnings.
So, Anastasia, I mean, we can move away from Ackman, the person for a moment, and just talk about the idea.
Sure.
That, have rates topped out? Or are they in the process of topping out? Because essentially that's what matters more than anything else.
Right. I think near term, the rates may have topped out. And the reason I say that, we're coming out of an incredibly strong Q3, and at least we're going to get the exact number later this week. But that's not likely to be repeated in the fourth quarter. I think economy is going to be a lot slower. So the growth factor that's propped up the 10-year Treasury, I think we can see some of that go back. We also have the core PCE inflation that comes out this Friday. We're looking for a year-over-year print of 3.7%. 3.7% on core, that's actually a really great number that's showing the inflation is decelerating. And then, we got the central bank policy. I think we kind of get it now. I think the markets get it, that it is high for longer. And so I think we've priced in the appropriate amount of that. So for those reasons, I think the 10-year can pause. I think there's another deeper story here, and that is the delinquencies are rising, charge-offs are starting to rise, corporate bankruptcy filings are starting to rise. So there is definitely some weakness that's emerging under the surface. So that's why I think Blackman was saying that there's definitely risks that are impossible to ignore.